Even now, everybody thinks renewables is something new. Actually, renewables was already getting pretty big in the late noughties. The world's invested 9 trillion over the last 20 years.
In 2011, we were about 11% renewables, and most of that was wind. When we launched the fund, we were in 20 to 25% renewable in the UK. And in the last 5 years, we've been operating for about 5 years, we've gone to double that. I'm very confident that within 5 years, we're going to be at about 70% renewables.
We're wasting 3/4 of the world's energy, half of the world's food, and 1/3 of the world's water. That's a deeply motivating set of facts. It's motivating because you can design solutions to those problems. Actually, that's what investment is all about. Investment is about trying to identify inefficiencies. Business is about trying to solve problems. More important than building new stuff is making sure that we're using the existing stuff more efficiently.
One of the key things about electricity is that supply and demand has to be balanced in real time. The need to balance things in real time and the intermittency created by renewables are at odds with each other. And that's where the magic glue of energy storage comes in. You simply just absorb power that's not needed at any moment in time, and you can release it when it is.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. SDCL is a fairly broad company now with operations across project management, advisory, real asset investment, private equity. We'll get to all that in just a sec, but tell me, what did SDCL look like in the early days on Tuesday after you went to HSBC on Monday? And said, guess what, guys? What was your original focus?
Actually, what was interesting about HSBC's reaction, because it's an extremely good institution, is that they said, look, okay, fine, but hold on a second. Wait, what exactly did you mean by environmental infrastructure? So actually, what my first day at work on October the 10th, 2007, that was the first day of SDCL's trading. What my day looked like, because actually I turned up at HSBC in the morning because what they asked me to do is they said, look, we actually think this is a rather good idea. We'd like you to explore it more deeply. We get that you want to set up your own financial institution, but why don't we be your first client? I spent the morning at HSBC. I packed up my boxes and I put them in the back of my, ashamed to say, my car. And at the time, and I drove across town, and I drove very close to here, actually, into the middle of Mayfair. Opened up in a little office with 2 people in it, me and one other, and carried on doing the same job. And we actually designed our first job at SDCL was designing a fund, which ultimately that was launched and successfully invested by HSBC, called the HSBC Environmental Infrastructure Fund. So for the first 5 years of our life, from 2007 to 12, the role that we played as a financial institution was advisory. And we've been investment since 2012, but it was advisory up until 2012. And that was our first deal. It was designing funds for the likes of HSBC. We did it for the World Bank and other financial institutions, the IFC, but designing funds with an investment policy, strategy, and approach which would invest capital in various stages of the infrastructure project lifecycle and in the supply chain for infrastructure projects that were associated with environmental infrastructure. So, projects ultimately that were good for the environment and society. So HSBC was our first client, actually had a very, very interesting business. We loved it, got to, again, get to know most of the governments and their attitudes in the late noughties and after the great financial crisis, how they wanted to channel capital into these markets, what technologies they were interested to support, got to know the investment community well, and also got to know what the investment market was prepared to do, Scott, and also what it wasn't. Where were the funding gaps going to be? At the time, like renewables, even now, everybody thinks renewables is something new. Actually, renewables was already getting pretty big in the late noughties. I mean, the world's invested 9 trillion over the last 20 years, most of it more recently, but still there'd been a pretty substantial amount of money invested by the end of the first decade of this century. But nobody, this is the thing that really taught me, there were things that nobody was looking at. There were like gaps complete gaps. And the biggest gap that I saw is what we do today. The biggest gap was, well, everybody was perfectly prepared to build something new, build a new power plant or build whatever it was. Nobody was interested in how to make the infrastructure more efficient, how you could build systems that actually did the same or more, but used less. So, this was the big thing for me. It was a sort of a journey of understanding the capital market was very good at building stuff and very bad at identifying how to address more gritty problems, like the biggest, dirtiest secret of the energy sector that I've learned over the last 17 years, most of it's wasted. That's the piece that we stepped into as an investor in 2012. But it was because of the information of the last 5 years.
So, Jonathan, maybe this is a good time to put a pin in this just for a moment. And you can tell me, what does sustainability mean to you personally? By this time in your life, you've made the decision. Obviously, you were voting with your feet. And you made the decision what you're committing your life energy to, right?
Sustainability, for me, is synonymous with resource efficiency. I don't mean to get too boring or technical, but actually, that really is the key. When I look back at everything I've done over the last 17 years, and I look at the way the world works, and the reason I wrote my book partly was to put all of those pieces on the table and see if it was still the same. The thing that's astonished me and motivates me more than anything is how much more efficient we can be with the use of our resources. Because going back to my childhood and my political convictions, the resources, meaning the stuff that we've always been mining, extracting, searching for, competing for politically, that stuff, and now that we're burning it, is creating climate change. That stuff are creating problems like conflict and climate change. But here's the exciting thing. We waste most of it. The reason I find that exciting is that that's a solvable problem. Like, if you were to wake up every morning and say, oh my God, what do we do? Like we've perfected the way that we operate, right? We're doing the best we possibly can, Scott. There's nothing more that we could possibly do. And yet, no good deed goes unpunished. Nothing more that we can do. And it's just getting worse. Okay, that would be a challenging thing. But when you wake up in the morning and say, we're wasting 3/4 of the world's energy, half of the world's food, and a third of the world's water, that's a deeply motivating set of facts. I think the other feature of it, though, is that it's motivating because you can design solutions to those problems. In fact, we took the I in SRI. Actually, that's what investment is all about. Investment is about trying to identify inefficiencies. Business is about trying to solve problems. So for me, sustainability or sustainable development for me is synonymous with resource efficiency, doing the same on what with less, just using less resources because we just use too much. We exceeded all of our planetary boundaries and the rest of it. But sustainable investment for me actually means solving those problems from a business perspective. And from an investment perspective, investing in inefficiency and solving those problems for me is the highest impact, most sustainable thing that we can do. You could argue there'll come a point in 25, 30 years when we would have arbitraged out from an investment perspective or perfected some of the inefficiencies. But we're so far from that, Scott. And solving that problem, how much of the stuff that we waste or squander today and the carbon and the cost of that, solving that problem for me is what the essence of sustainability is. More important than building new stuff is making sure that we're using the existing stuff more efficiently.
Is that true? 3/4 of the world's energy is wasted?
That question is the other reason I wrote my book. I'm a busy guy. I've got a business to run and the rest of it. And we've got $2.5 billion invested in 10 countries, 50,000 properties and so on. So, and I've got a family and they would probably have not lost me to, my computer screen for a year to do this. But it's actually to answer that question because it's so nuts, isn't it? It's extraordinary and it's unbelievable. And it sounds crazy. I'm very grateful to my publisher. It's a division of Hachette, Hodder and Stoughton, who published it, the second largest publisher on earth. But it's partly because I wanted to demonstrate this. But I'll break it down very quickly just to give you conceptualize it so it doesn't sound as nuts. In the energy sector, you have to get energy from somewhere. 80% of it's oil, gas and coal. So generally speaking, you lose, first of all, about 10% of the primary energy just in extraction and conversion into the system somewhere, to pipes, into making it into a grade that it can get used in the energy system, say in power plants or in the transport sector. So it's about a 10% loss, 9%, 13%. That's a small part. The biggest part of the world's energy gets lost as heat. It's about half of it. In fact, that's being charitable. About half of the world's energy gets lost as heat. For example, everybody thinks of electricity, so I'm just going to go along with that for a second. But if you think about a power plant, like a gas-fired power plant, which is the largest fuel source for power in any major economy at the moment, if you put a molecule in a power plant, half of it turns into electricity, the other half turns into heat. By the way, which is fine if you use it, but if you've got a centralized power plant, which is how we've built the energy system in America and in Europe, centralized power plant, the electricity goes into the grid, but the heat goes up, and there's nobody close to use the heat. So they just dump it, waste. It goes, in fact, it doesn't disappear. It just goes up into space where it's not really needed. But think about this. By the time the power has come out of the power plant, 60% of the primary energy, the original fuel, has been lost. 60%. Now, then it goes on to the transmission and distribution wires. So by the time it's in your building in Mexico or mine in London, another 10%, so 60% plus 10% has been lost on average. So in the United States, since the 1970s, the Lawrence Livermore National Laboratory has been calculating what they call useful energy, that is the amount of energy that gets from the primary energy source to the end user, and then what they call rejected energy, in other words, the amount of energy that gets lost in the system. And very broadly, it's been between 67 and 70% since the 70s. There's lots of things that haven't changed since the 70s. We're still almost entirely fossil fuel based as we used to be, and we still waste most of our energy, even before it gets to the point of use.
That's extraordinary. I'd love to drill down more on that, but we got to get to SDCL. Maybe you could start with a high-level overview of SDCL and maybe start at the beginning with its mission and just describe at a high level for a moment its activity, investing focus, and you could walk us through the timeline of SDCL to becoming what it is today, because you started out as advisory and now you're investing.
That problem that I just described, the fact that we waste most of the energy, is actually the mission. It's the mission of SDCL is to solve that problem. And tying a little bit back to kind of the prehistory, the first 5 years I described to you earlier as doing a lot of work for financial institutions, but there was another side to our business in parallel, which illustrated to me the opportunity of solving the problem. It wasn't just financial institutions that hired us as an advisor, it was companies. And it's companies to solve the physical problem, because the companies recognized, as it stands today, that 90% of their carbon footprint was in their supply chain. And in the late noughties, big companies, I won't name them from today, but very big famous brands wanted to do something about this. And they hired companies like ours, actually, to go out and find solutions to these problems in their supply chain. And we found solutions in energy efficiency, making factories more efficient, reducing the amount of energy that was wasted at the point of the manufacturing process, which reduced the carbon and so on. So by the time we started investing in projects in 2012, with the mission to cut energy waste, to invest in solutions to this big problem, we knew a lot about the subject. We knew that there was a funding gap because of our experience in the financial markets, but we knew literally from the coalface, from working on the ground and factory floors in China for big international brands, working in hotels and data centers and hospitals, we knew that there were problems on energy, that there wasn't enough, let alone low carbon. There was availability problems with energy, there was high cost problems with energy, but it was also just huge wastage in getting it to the point of use. And also when it was there, the buildings that were using it, buildings, industry, transport, 70% of energy demand, were using it inefficiently. So by the time we started investing, we knew what these problems were, but we had also started to design solutions to these problems. What does that look like? So if you want to solve the problem that the grid's incredibly inefficient and wastes 75% of the energy before it gets to the point of use, you can generate energy on site, and that cuts out generation, transmission, distribution losses. As our mission as a financial investment firm, we started to develop physically and then financially invest in projects that solve these problems. So we decarbonized hospitals and data centers and hotels using the equipment that we had learned about as an advisor, but then deploying capital to turn the projects into a service for customers. Customers didn't have to spend money to implement the project. They didn't have to know how to implement the project. We would design the project, we would explain how, we would provide the capital, and then clients would pay for the energy service that we delivered for them that was lower carbon, lower cost, and more reliable. Very often, most often out of the savings generated because we were able to make the whole system so much more efficient. That's how we started our journey as an investor, but that's exactly where we are today. It's actually the same fundamental idea we had as we started investing in 2012 in solutions to these problems in buildings, industry, transport. All we've done for the last, I'd say, 14 years is more of the same. And we've now built projects in our portfolios that connect to over 50,000 properties in 10 countries. We've solved these problems for steel mills, chemical plants, very excitingly, the data center market, for hospitals, for government buildings, for logistics, parks and facilities, even for residential communities. So this is what's exciting. This basic problem that we identified years ago, there are solutions to the problem. And we've built a portfolio now of over $2 billion of projects which solve these problems. So if somebody asked me today, can it be done? We have quite a big set of proof points.
I want to drill down on that more, but let's first start out with an overview. You've got a couple funds that you're doing. I think your largest one in 2018 you launched is SEEIT, which was the first UK listed investment trust focusing exclusively on energy efficient projects. So first of all, how did the name come about?
Nobody's ever got the joke. It's what my kids would groan and say as a dad joke. It's just see it. Can you see it? But it's the SDCL Energy Efficiency Income Trust. That's what the acronym stands for.
What is the ticker?
The ticker is SEIT.
Okay.
And it's traded on the main market of the London Stock Exchange. And look, the investment thesis was to invest in, I should say, and then improve projects that deliver energy to customers that's lower cost, lower carbon, and more reliable. But through the same techniques I was just illustrating, that is on-site energy generation that avoids the losses associated with the grid, and also projects that reduce the amount of energy that buildings use. So, for example, more efficient lights or heating, ventilation, air conditioning systems. For me, those are the two most impactful, profitable solutions to the energy problem. In fact, it's actually what the acronym of my book means: efficient and decentralized generation of energy. Efficient meaning, can we change our infrastructure inside of buildings, industry and transport to do the same job or more, just using less energy? And the answer is yes. The Department of Energy in the US says that about 30% of the energy inside buildings is just wasted because it's got the wrong lighting, heating, ventilation, air conditioning system. I agree with that because that's my day-to-day experience. So we invest in solutions to that problem. And then the decentralized generation is things like it's got solar and storage. You just put energy exactly where it's needed and deliver it directly to the end customer. Cogeneration, recycling waste gases or waste heat and using it to create power and steam in the industrial context. So that's what our portfolios do, and that's what SEEIT does. It buys mostly operational projects and then expands them and improves them and scales them up.
Why did you decide to launch as a PLC rather than a PE fund? It
was a PE fund in a sense. We launched a fund backed by the British government in 2014, and it was called the UK Energy Efficiency Investments Fund. It was actually cornerstoned by the British government's Green Investment Bank. So it was a first of a kind fund. It was the first institutional fund in the UK to invest in energy efficiency projects. And the mission of the fund was it's about £100 million fund. The mission of the fund was to design, build, finance, and then operate and maintain a series of these projects, on-site generation and efficiency projects. And the fund had done, I think, a great job because it closed in 2014. And by 2018, it had basically committed its £100 million and it had got its portfolio operational. So what happens is, Scott, in private equity or infrastructure funds, there comes a point at which your investors expect you to exit or recycle their capital. And that would happen relatively quickly, about 4.5 years after we launched it. We looked for opportunities what the best opportunity was for investors at the time. And candidly, I recycled the same idea that we spoke about earlier that I had when I was at HSBC, and we had the same problem in 2006, and said, okay, one of the best ways I've ever seen to exit an infrastructure portfolio that's working great and then to scale up the strategy is to list it on the stock exchange. I did that the first time in 2006. Why don't we do it again with the UK Energy Efficiency Investments Fund? That's exactly what we did. And in December 2018, we took it public. And that was the beginning of See It.
For listeners who are unfamiliar with the structure, can you just explain this type of investment trust structure?
An investment trust is effectively a company. It's a regular company in many respects. It's listed on the stock exchange. Anyone on Apple stocks or whatever can see the stock and buy it through their stockbroker. It's relatively liquid today. The reason it's called an investment trust is that there are specific listing rules when you want to take a company public. There is a chapter in those listing rules which relates to investment companies, and there are certain features that investment companies offer which are typically or historically attractive to investors. So, for example, there are a set of governance limitations that are put around these companies, limitations in maximum exposure to any individual project, for example. So they're built to be diversified portfolios and operate like a fund, but listed on the stock exchange. So that's what an investment trust is. In fact, Scott, frankly, for anybody in America, that's what built the railways across the States originally. For anybody in the UK, there are some companies which nobody knows are investment trusts, like Daily Mail and General Trust. It was an investment trust that owned up media assets. 3i, a very famous venture industrial business, as an investment trust. But, See It joined the ranks of infrastructure investment trusts or investment companies that had started to got listed up. I listed the HSBC one in 2006, and it's become a $10 billion business here in London.
So it's a completely open fund with immediate liquidity then, right?
It's subject to liquidity in the market, but if any investors want to buy and sell shares, they can take advice from their stockbroker and they can buy and sell shares on the open market on the London Stock Exchange.
And what's the total assets under management?
So the enterprise value of the portfolio is about £1.5 billion, and that's comprised about £500 million worth of debt financing of projects and about £1 billion of equity.
Who are the investors primarily?
It's a blue chip shareholder register. Thrilled. A lot of it's in the public domain, but the typical characteristic would be insurance companies, pension funds, institutional asset managers, private client stockbrokers, some very large, institutional funds. More and more these days look at See It as a proxy for an operating company, that owns energy assets all over the world.
Is most of the capital in there already deployed?
All of the capital is deployed, and it generates cash flows. Those cash flows then allow us to service a dividend. So it pays dividends quarterly.
And targeted returns, what do you shoot for?
The latest valuation that we conducted, and we printed our annual report and accounts in June related to the end of March, the discount rate or the rate of return that applies to our portfolio at its NAV is about 9.5%, or about 11 levered. So that gives kind of a sense of what the total return might be expected to be from our net asset value. I think good news for new investors, not so good news for existing investors, is that the shares trade below net asset value. So some might say it's a remarkable investment opportunity for investors who can buy shares in a company below its net asset value.
What are you benchmarking against? Utilities or what? I guess you're not generating energy, but
in any investment thesis, in an investment case, it's a layer cake is probably the best way of describing it. The base of your layer cake has to be risk-free rates. And then, there are risk premia that attach to the specific, the sectoral, but also the specific risks that you're investing in. So when we look at our portfolio, we'll look at the risk-free rate in the relevant country. We'll look at the risk premium associated with corporate credit. We'll look at the risk premium associated with the liquidity or illiquidity of whatever we're holding. We'll look at whether or not there are construction risks, Scott. So if we're building new projects that put solar on people's rooftops and commercial industrial context, we'll take that into account. We'll take the operation and maintenance risks into account. So it's a stack of risks which have a commensurate return. And that's broadly how we calculate the discount rate or the rate of return that we require on any new investment.
I know you're operating internationally. So what regions are you active in? What countries do you have actual employees on the ground?
As an investment firm, we have about 55 people here at SDCL that work directly for the firm, but we have somewhere between 350 and 400 people under full-time employment through our portfolio companies and projects. Those portfolio companies for our projects, about 70% of the value is in the United States of America. I think this is right, although we may have done a project but I think right now we've invested in every state in the United States other than Hawaii, which is nothing wrong with Hawaii. We just haven't managed to get something done there yet. That's about 70% of our capital. We've got a very large footprint and growing footprint, rapidly growing footprint, I should say, in Europe. Republic of Ireland is a really big market for us. That's obviously a hotbed of the data center market, which is a very large focus for us as an industrial vertical. UK is our home country, but has a relatively small proportion of our capital invested here, looking to do more, hence our partnership with the Mayor of London to launch a fund specifically for the London market. Spain, Portugal, so the Iberian Peninsula, we've got circular economy projects, cogeneration projects. Sweden, we've got a fantastic network in Stockholm. So we are actually Stockholm's gas grid, but don't worry, it's a green gas network. It's taking mostly the waste gases from wastewater treatment plant that would otherwise be polluting, and we use those as the gas network for Stockholm. And then we've got a small footprint in Asia, actually. Going back to my HSBC heritage, we've had an office in Hong Kong, we've got an office in Singapore, and we invest in projects in Singapore, Vietnam, and we're moving into Malaysia.
I think you've hit all around this, but I'd like you to succinctly tell me what's SDCL's theory of change and the problem or the problems that you're trying to solve specifically.
Our theory of change is that we think that the intersection of the energy with the economy and the environment, the interface of those three elements, is the most fundamental issue that we need to look at for the next generation, primarily because of climate change, but also because of other socioeconomic factors that emerge and even geopolitical factors that emerge. So our theory of change is that something has to change and that nothing much has for the last 20 years. And I don't mean that in the sense that we haven't been well-meaning. And I'm not saying that we've had bad policy design, but I'm being realistic. So come back, I'll give you a theory of change in a second, but what's the theory of non-change? The theory of non-change is that how can we say that there's been change when over the last 20 years, after $9 trillion of investment in clean energy and in the grid, with everything that we've said and done, with the UNFCCC, with Nobel Prizes, with movements, how can we say there's been change when particulate emissions have been going up about the same every year over the last 20 years with barely any detectable difference? How can we say that we've made a change when the proportion of fossil fuels in the global energy system is about the same as it was? We've added, there's more of everything. We can say that the energy system of a century or 2 centuries ago was bioenergy and now it's dominated by different forms. Well, we just use more bioenergy than they did 100, 200 years ago. It's just more of everything, right? So that's the theory of non-change. The theory of change is this. What if we needed and wanted to do something about this? What if we needed to cut carbon? What if we needed to improve resource efficiency because we just are using much more than the planet can produce sustainably? Our planetary boundaries have been blown over the 9. We're just using too much. We're probably using 1.75 planets of resources a year. So what exactly can we do about this? So my theory of change is as follows. The largest, fastest, cheapest and cleanest source of greenhouse gas emission reductions and reduction in extraction and social destruction associated with extraction of minerals and metals. The largest, fastest, cheapest and cleanest solution to that is being more efficient, doing the same or more with less. So just at the same time, it's not to denigrate it, just at the same time as we spend the next decades innovating and building the best, cleanest infrastructure we possibly can, renewable power and the rest of it, the theory of change is we have to be more efficient. We have to cut out as much as we can with 75% of the energy, half of the food and a third of the water that the world's wasting. And by the way, Scott, if we don't, we're not going to get anywhere. Not with net zero. We're not going to have a sustainable economic environment, and we're going to keep having wars over the stuff that we're fighting over.
I guess you've identified energy efficiency as the low-hanging fruit of this problem out there. What does it mean in practical terms, and what does it mean practically? Because I'm sure there's a lot of people listening who haven't thought much about this as an investment concept. I'm sure a lot of people have heard it referred to because it's not an uncommon term in the business. It's thrown around a lot. But I want to make sure we're all on the same page today, what it means to you and SDCL, because I want to get down into how this generates a return.
I'll start with like a very, very pure version of efficiency. So let's say that you own a portfolio of 800 buildings around the country, and let's say that you're a bank. Santander Bank is a great example of this in 2015. At the time, certain clients still suffer from this, like the NHS today. But at the time, Santander recognized that almost all of its lights were inefficient. Like, for example, they had sort of regular light bulbs. By changing those light bulbs to LED light bulbs, they identified with a technical partner of ours at the time, GE Lighting, that they could dramatically reduce the amount of energy they were using. Now, they didn't need to turn the lights off. Like, they could have the same lighting product, even better actually, because it would require less maintenance. It's just that it would use much less energy. So you could take out of a ceiling a 60-watt lamp and replace it with a 6-watt lamp, and it would make the same amount of light. But de facto, it would reduce the amount of energy like for like by 90%, right? So this was kind of the opportunity, or what you would refer to as low-hanging fruit in 2015. What we did is we worked with GE Lighting to design a system where we didn't just replace one of those light bulbs, we replaced 90,000 of them in 800 buildings, all in one go in a 9-month program. Okay, here's the other problem. This is the financial problem. If you're saying, you might think Santander has all the money in the world, but it's still a company with an operating budget. So the cost of doing that was about $20 million. Now, that $20 million was not a normal operating budget for their facilities management business. Second of all, it required an extraordinary level of project management and coordination. So it wasn't just capital, but it was help. Somebody had to take responsibility for changing 90,000 lights, right? So that's where we stepped in, and we wrapped the project up to make sure that it had the right delivery capability to design, install, and operate and maintain. And instead of Santander having to pay $20 million to implement the project, we paid the $20 million, and we charged Santander a fee to provide light as a service to them for 10 years. So that's how we turned it from a problem into an investment. We made our investment, which was the capital expenditure to install the project, and our return was the cash flows associated with the service charge that we charged Santander. Now, for Santander, it was a great deal because the payment that they made to us under our service charge, which was our income, our return on investment, was less than the payment that they would have made had they not changed their light bulbs. So actually, they just paid us out of the savings.
When you say less than the payment they would have made, is this for their power payment?
The payment that they would have made was two things. Previously, going back to my example of a 60-watt lamp for a 6-watt lamp, for every single one of those lamps, they were paying the money involved with running a 60-watt lamp rather than a 6-watt lamp. So it was much more expensive. After we installed the lamps, then, of course, the price went down very dramatically. So it involved a very substantial financial saving for Santander. But in addition to the financial saving, if you think about a lamp burning 60 watts compared to a lamp using 6 watts, the carbon efficiency was so much better afterwards than before. So Santander were getting two benefits out of this. It was a significant cost reduction, but also a significant carbon reduction. And then there was a third benefit, which was the quality of the infrastructure. So once we'd made the investment, they used to have people running around the country in white vans doing emergency repairs for light bulbs that kept going out. But as we all know, LEDs come with warranties, 5-10-year warranties, which means that you don't have to replace them. Or if they did, they'd have a phone number they could call and somebody would come out and replace it for them. So we delivered the project as a service for Santander. There was no upfront capital cost. They paid us a return on our investment, our $20 million, over time. as a service. They paid for a light as a service over 10 years. We earned a return on our investment that was acceptable to us. Santander paid us for that service, but it was less than they would have paid for those very expensive 60-watt lamps.
And is this service something that is effectively calculated and negotiated when you go in with the project, or are you paying the power bill and charging them what they were paying before? How does it work?
They carry on paying their energy bills. They're just paying less because they're not using as much energy. They pay us for the lighting as a service, but they don't pay us, Scott, if the light isn't available for use. So they pay us so long as the lights are available, so long as they don't degrade below a certain level, so long as the color temperature was what they wanted, and so on. So there are key performance indicators. So that's a very clear. We've done many of these projects in the UK, in the US, and around the world. But using finance can spread the capital cost of an asset over its useful life, right? And also in infrastructure investors like ourselves can take risk. We can take the risk on the design, the implementation, and the operation of projects. So that's what this does for clients. We design, install, operate, and maintain projects with our industrial partners, and then clients can pay for the service. They only pay to the extent the service is made available to them. So for example, lighting, or you could do this with cooling or heating. But in each case, the client has the benefit of paying for the project as a service, but the payments they make, including our service costs and all the electricity costs that they're paying to run their system, are less than they would have been had we not done the project for them. So that's on the kind of the savings side. Something that we learned over the years, and I referred to it at the beginning, is that, and here's a bit of a tragedy, you can make your building. This was a heartbreaking moment for me because I'd done all these projects for Santander and all sorts of other customers, and we tried to make these buildings as efficient as possible. And then the realization was, oh my God, actually, most of the energy's been wasted even before it's got to the building. Here we are. This is what we were saying to the Mayor of London. Well, we've just launched a new fund with them. Here we are in London. We could make all of London's buildings more efficient, but 2/3 of the energy has been lost before it gets into town. Going to the point that I made before through the extraction, generation, transmission, and distribution process. So what can we do to solve that problem? So that's the other side of the coin, and the other side of our investments. And to solve that problem, you asked about practical examples. We will build the energies, that is the power or the heating or the cooling service, at the point of use. So rather than if you've got a data center, Scott, in the middle of town, rather than you having to rely on the grid, where by the time the energy's got to the data center, 2/3 of the energy's been lost on the way, instead we'll build the energy system right there at the point of use, and we'll produce as low carbon as possible, 24/7 power, cooling for a data center. If you're a hospital, we'll provide power, heating, hot water, cooling. If you're a logistics facility, we'll put solar panels on your roof. And instead of you losing the energy through the transmission and distribution system and paying your utility bill, half of which has got nothing to do with wholesale energy prices, it's got to do with the cost you have to bear for the network. Instead of doing that, we'll produce the power cheaper, cleaner, and more reliable for you on site. The UK's, we were joking about it before we got started, but the UK is not famous for being a very sunny location. But from 2019, it's been cheaper to buy solar power that you produce on your own site in an industrial context than it has been to buy it from the grid.
I'd like to drill a little more into your See It investment vehicle and strategy. Who are typically the end users in these projects?
Big market for us is actually steel. Not tremendously fashionable. Doesn't sound particularly green, does it? Steel is a big deal. I mean, everything relies on it. Really, you can't build wind turbines without it, Scott. So you have to accept that it's got a role to play. A lot of the steel industry, although it's moving to electric arc furnaces to be more environmentally friendly, amongst other things, it still relies on blast furnaces. So, for example, we have a major project in See It's portfolio that I think is absolutely fantastic. When you've got a blast furnace, typically they can reject gas, hot gases, and they literally boil the atmosphere. The project that we've invested in See It's portfolio serves Cleveland Cliffs, the old ArcelorMittal USA steel mills, and US Steel, famously going through a merger at the moment. And it serves those steel mills by capturing waste gases, waste heat, effectively, coming out of the blast furnaces. What would otherwise be pollution boiling the atmosphere is captured, Scott, and it's piped back into turbines. And the turbines then produce steam, which is needed by the steel mills, and power, which is needed by the steel mills. So what it's doing is it's recycling energy. What would otherwise be waste, part of that 50% of the world's energy that goes up in smoke into space, what it's doing is it's capturing it, recycling it, and putting power and steam back into the industrial process. And it's doing it at big scale. We've got about 298 megawatts of on-site generation, most of which is recycled energy. It's so impactful that it gets about 1.5 clean energy or renewable energy certificates for every one equivalent megawatt in the solar market, for example. So that's how beneficial it is from a pollution prevention and energy recycling perspective. That's what I would call, people call that hard to abate in the steel industry. Steel, cement, chemicals, and plastics is about 40% of the world's greenhouse gas footprint. So, that's a big one as an example. We've got a project in the northern side of New York State, and that runs 16 utility services on site for about 116 customers, big logistics and fulfillment customers through to the food and beverage industry. So that's a very interesting network. We have one of the largest solar and storage platforms in America in its portfolio, a company called Onyx Renewables, which does solar and storage across schools, hospitals, government buildings, commercial and industrial facilities nationwide. We've got lighting as a service, going back to my Santander example, across the country through one of our portfolio companies. So that's what's in SEEIT in the US. In Europe, I mentioned Stockholm's gas grid, which is fueled mostly using the gas that would otherwise be spewed out of the back of wastewater treatment facilities, but instead is captured by us and used as the gas network for Stockholm. We've got projects that serve the olive industry in Spain, the paper industry in Portugal. And then you asked me to be insinuated that steel mills in the United States weren't sexy. So let's try this one. Hyperscale data centers in here in Europe is a market that we've been very focused on for years, because SEEIT, for example, got started. One of its earliest investments was owning on-site energy generation systems for companies like Citigroup, where we own and operate their critical energy service. Energy center for their data center here in central London. So that gives you a sort of flavor for the portfolio. It's high quality projects. It's contracted with end customers. The contracts deliver customers energy at an affordable price, which is typically lower, substantially lower than the grid. Energy that's designed to be lower carbon than the energy system of the countries in which it operates, and energy which is designed to be, and this is really critical for sustainability, reliable. Because we have to wake up. I have to wake up every morning with my 50,000 customers. So it's got to be available. It's got to be reliable. It's got to be secure. And if you're a data center, a hospital, a steel mill, a manufacturer, you're going to rely on these projects to deliver the energy services that you need when you need them. That is the characteristics to its portfolio: cheaper, cleaner, more reliable.
How do you define your investment universe? What are the key screens or hurdles that have to be passed for you to move forward on something?
The primary philosophy behind our projects is going back to the problem we're trying to solve. It's not how do we sell more solar panels or batteries or hydrogen fuel cells. It's how do we get the lowest cost, lowest carbon, most secure solution for our customers. So the first question is, who are the customers? The customers are buildings, industry, and transport. That's where 70% of the world's energy is used. That's where the battle's going to be won or lost around carbon, around the economy, and around the environment and society. It's the actual end user. Most people think about the grid, Scott. There's nothing wrong with the grid. It doesn't have any feelings, so it's convenient. But the buildings, industry, and transport, that's where the action is. So that's our customer. So that's how we define our universe. Then what's their problem? Where are they? What do they need? It's typically one of those three things, or all of them together. And then we'll design solutions to those problems, or we'll invest in solutions to those problems. And the solutions take many, many manifestations. But it's either on-site generation, or it's projects that reduce energy consumption, lots of different technologies, but you're solving the same fundamental problem every time. how do I produce a solution for this customer that involves wasting less energy than the grid?
So one of the key differentiators of your investment strategy, if I've understood this right, is there's no upfront capital required for the end user by the target company that is deploying the energy efficiency project. In the example you gave me of Santander, where you're providing light bulb service or lighting service, I don't know how you described it, does that have a term that expires? Because that's really kind of a service that's got calculated savings, as opposed to when you're constructing decentralized energy generation. There you've got a real PP&E, and I imagine that's a standalone asset that you eventually maybe spin off.
You're entering into a contract, let's call it 10 years, to provide light. You could also be providing another service, another energy service like power or heating or cooling. So our projects will own the equipment that deliver those services, lighting, heating, power, or some derivative thereof. It's typically under a contract with a limited life. You're right, about 10 years, 15 years. Some of our contracts go 20, 30 years, but the typical average life in our contract is actually about 15 years. So throughout that period of time, we will provide the energy service to the standard documented under the contract. Scott, if you're a data center and you need energy made available to you when you need it, you pay us our service charge. It could be a 10, 15-year contract, and we will deliver you the energy service. And to the extent that we don't, you don't pay. And all of our contracts fundamentally work in a similar format.
But are there some key risks to your strategy?
At different stages. So there are two different stages. It's building things and operating them. So at building things, there's always risks. You've got to manage and eliminate those risks. So it's getting the right design, construction, managing your supply chain, getting up in the morning when you're in France and flying off to Nice to Munich rather to go and make sure your suppliers deliver on time and on budget. Yeah, and make sure that you don't run off the road when your tire explodes. So yes, of course there are risks during construction, but they should be managed. By the way, there are plenty of risks involved with building a new nuclear power station. I do not mean the uranium. Think about how long it takes, how fast they run out of over budget and over time, right? So the same sort of things apply. You've got to manage that risk. And then, during the operation and maintenance, you've got to build with high quality. And one of the things I love about energy efficiency is we are not sitting around waiting for the technology, Scott, to be invented. Well, oh my God, in a few years, will we possibly be able to do X, Y, and Z? I mean, I'm so excited about what's going on in things like, I don't know, carbon capture, various other technologies, see what happens in the hydrogen sector. But you know what? Right now, today, all the technology exists substantially to deliver the change that I was talking about all day. So, that's exciting. But somebody's got to make sure it's operated properly. So, of course, there are risks, but that's what infrastructure investing is all about, is investing in risks that can be identified and mitigated. That's what a professional institutional investor can do.
It seems to me that you hold the holy grail of the whole renewable energy puzzle, because when I hear critics talk about renewables, it's that solar and wind is great when there's sun and wind and not great at night. Honestly, I don't hear a lot of people talking about energy storage very much. So I want to get into all that. I guess you call that stationary infrastructure energy storage. But first, can you just give me a high-level introduction to Gresham House?
So Gresham House is a fund management business focused on, alternative investment strategies. So we don't happen to have some of the more traditional alternative areas like hedge funds, and we've very much focused over the last few years. And Gresham House was a small business when I joined it. It's a much bigger business. We're running in the region of £8.5 billion today. We've focused very much on areas of sustainability. So I'm not using the word ESG. I'm not using other expressions. It's very much I think it fits the bill as a sustainable areas of investment. And in particular, the largest areas are forestry, over a third of our assets under management. And we're the largest investor in commercial forestry in the UK and Ireland, where, especially in terms of non-state-owned or church-owned forests. and then also investing increasingly in other areas abroad, in particular Australia and New Zealand. So that's a really interesting business for all sorts of different reasons. Obviously, it's natural capital. It's a material that's likely to see its use increase very significantly as it becomes a better and better engineered material. We can go on to that separately. The new energy business is running, which I'm the managing director of, manages in the region of £1.4 billion. We've got a sustainable infrastructure business running somewhere just south of £1 billion of capital, and that run. We've got two products there with the same name with different vintages, essentially, which is the British Strategic Investment Fund, and it's renamed to being the Sustainable Infrastructure Fund. So and that invests in all sorts of different areas, including the initial investment that we're making to Grid, the fund I run, as well as areas like waste, digital infrastructure, and also social infrastructure as well. So areas like nurseries and other areas sort of like assisted living. So very interesting business, as well as having what we call a habitat bank. Increasingly, laws are coming into place to require net gains from a biodiversity perspective when there's development. So if you're going to go and ruin a little bit of of the landscape, including the projects that we have to do to green the electricity infrastructure, there has to be a net gain now. It's law. The Environment Act required this, and you basically have to go and replace what you've got. And the Environment Bank allows you to just pay and get that done by someone else extremely efficiently and knowledgeably, rather than having to do it yourself. So that's a really interesting area of growth for all of the sustainable infrastructure is a very interesting area of growth, as is the area I run. And then in addition to that, we have a housing or real estate business focused on mostly residential housing. And that's a combination of social housing and retirement housing, amongst other things. And then last but not least, very interesting area in terms of a UK investment area, both public and private, that operated very much with a private equity mentality, to the extent that we're trying to influence and support businesses of all kinds to grow. And it's not quite the traditional measure of sustainable alternative investments, but it's a unique way of investing. We've got a fantastic track record in that area.
Let's now drill down what you're doing. You're the head of the new energy division, but I believe you have 2 VC funds also, or do you have more funds than that? Or
no, we've within the new energy division, we've got the largest fund is the Gresham House Energy Storage Fund, Grid, and that's a listed investment trust with a net asset value of in the region of £840 million. That's the bulk of I wouldn't call it the bulk because it's over 50% of the assets that we've got within the division. But in addition to that, we've got a handful of other funds investing in both renewables, co-location. And co-location is a catchphrase for the combination of batteries and more often than not solar on a single project, and sharing a single connection with the network. So co-location, and so we've got wind, solar, co-located solar storage, and energy storage.
your targeted returns are what?
Our target returns are in excess of 10%.
I think the last 2 years you were in healthy double digits.
Yeah, absolutely. It depends what you're looking at. The NAV, the total return from an NAV perspective, has been extremely healthy. Unfortunately, the share price rolling over has taken down the return. But yes, absolutely. Despite that, we're in pretty healthy territory.
Can you just give an introduction to battery storage and the need for battery infrastructure that's really driving or the core of your whole strategy?
Yeah, absolutely. So I'll never forget in 2008, 2010, people telling me that, the renewable sector is really interesting, and everyone wants to decarbonize, of course, but the market won't be able to absorb all the intermittency. When penetration of renewables gets above, different numbers will quote you, 10%, 15%, and so on. And slowly but surely, of course, the levels of penetration rose. And, in 2011, you were at about 11% as it happens. When you got to 2015, you were up to 20%, and up and up and up it went. And then, of course, the need became really obvious once you did get to those higher levels, even though it was still quite low overall, that the intermittency was starting to make balancing of the system. And electricity, one of the key things about electricity is that supply and demand has to be balanced in all time frames, in real time. You cannot just go, whoops, I provided too much power there. That sends the voltage and the frequency of the electricity totally out of its needed parameters and starts taking things off the grid from both generation and devices and or breaking them. The need to balance things in real time and the intermittency created by renewables are at odds with each other. And that's where the magic glue of batteries comes in. And more generic energy storage comes in to the picture. You simply just absorb power that's not needed at any moment in time, and you can release it when it is.
So this is true not only of renewable energy, this is true of traditionally produced energy, or not?
That's true. To the extent that you've got base load, which is delivered in blocks, whether it was nuclear or coal, they're basically blocks of power and you don't vary the output. The demand would be varying. So you still have to deal with, I wouldn't call it intermittency, but fluctuations in demand. And therefore the blocks of power needed something. And that something typically was things like pump storage and smaller gas engines, or peakers as we call them, to meet the demand. So you had a baseload power which would always be below the demand level, and then you dialed up what you needed to make up the difference. The difference with renewables is that they can generate more than you need as well as less than you need, and that's the challenge. That where you need batteries to absorb power, not just something to, dial up. You need something to take power off without ideally switching it off and losing it forever.
So your business is buying energy when there's oversupply and reselling it when there's short supply, and you're storing it. So your investments are actually into, we'll get into it, but battery farms or whatever, and you're storing energy and then you're reselling and effectively trading, I suppose. Huh?
Absolutely right. We're trading power.
Are you doing this only with renewable energy, or you don't care where it comes from?
We have no choice. We connect to the network. Well, we could have a choice and decide to only connect to renewables projects. That would make our business very odd and very limited. We really have to connect to the national network. And so we need to store power that comes from the entire network. And so it'll be the electrons that we're taking off the network will be from the average renewable, so overall generation mix that it prevails at that time. What is interesting, though, is that when you tend to absorb power, the power price is low, which tends to be a function of there being too much renewable generation. And so it is skewed to absorbing renewable generation, and then you release it. But the more important point is that this is being installed so that we can then, when we get to 80% renewables, actually have a way of balancing it. You can't start investing in batteries when you're 100% renewables. You need a journey there. You need to deal with intermittency as you get there. So we have to absorb the power that is there to unlock the investment in renewables from current levels to much higher levels.
It's not a sustainability play per se, but you're providing a key piece of infrastructure that is very conducive to enabling a transition towards alternative forms of energy production.
There are all sorts of definitions for sustainability. I would call this sustainability. I wouldn't call it natural capital. We're not Article 9 under SFDR. We're not investing in trees and landscape and things like this, which are natural capital, which I think is really the toughest bar in terms of achieving Article 9, because we're actually putting things in the ground, and you can then say that we have to buy for product that use materials that were mined, and that's the simple reality of what we're doing. But we are unlocking the collapse in carbon emissions, and that allows the world to sustain itself.
And you're investing primarily in these, do you call them battery farms?
Solar tested be called a solar farm, but we don't call them solar. We call them battery projects or energy storage projects.
Battery projects, right?
Yeah, some people call them BESS, battery energy storage systems.
These are something like, I don't know, 30 million quid batteries. We're not talking about batteries like you put in your TV remote controller, right?
Very, very different.
Yeah. How big are these things physically, like size-wise, just to paint a picture in the mind here?
A relatively large project based on what's getting built these days is anywhere up to in the region of 5 acres of ground covered with, not densely covered, you've got to space the containers, but covered with containers filled with batteries. And those batteries operated, not obviously, so many, but operated a direct current And while the network operates at alternating current, you'll be familiar, AC power. And so you need other pieces of equipment to make sure that the batteries and the grid can convert the power that's stored on site into the power that's needed for the network. And what you need for power for the network is to take it to AC power and then take it up to the voltage that the network that you're connecting to is operating at. And that can be 33,000 volts, while the network on the site might be 1,000 or 1,500 volts. So you need other infrastructure on site to make it possible.
So you have these containers that are filled with batteries. Like, what's the size of a battery?
The individual battery cells, as they're called, are called pouch cells, about the size of a large mobile phone today, in both shape and size.
And where are most of these batteries made?
Today, they're still mostly made in China, but manufacturing facilities are being established all over the world right now. Mostly, and this is an important sidebar, is the lithium batteries are being used more for electric vehicles than for stationary purposes today. So the stationary energy storage market benefits hugely from the volume demand created by the EV market, even though the manufacturing lines are configured differently to meet these specifications for the cells that we need versus those that go into electric cars. But they're very similar devices otherwise.
So if I understand right, you build these giant battery storage plants. Do they physically sit next to the grid, or?
Yeah. On our website and our reports, we show you have substations all over the country. These substations are basically nodes where the electricity can be change direction, essentially, and or be taken off the high voltage grid to then sort of siphon off into population centers and or industrial bases. And we connect oftentimes at these substations. You don't have to. You can connect onto cables as well, but typically into substations. And you try and position yourself as close to that substation as possible so that your cable route can be the cable that runs between your project and the substation in question is as short as possible. It just makes life easier.
You plug these in and they're used when the grid needs spare capacity. And so they're a fallback mechanism, essentially. Is that correct?
Except they're used all the time.
All the time.
All the time. Many, many times a day, if not continuously, depending on the service we're providing.
It sounds simple, and I understand that's not really the full picture. And I say that I understand that because I've heard you say it's simple to explain, but complicated to solve in another interview you did. So what are the complications associated with your business?
Complications both in terms of the revenue model, in terms of, how does the marketplace contract with batteries? And there are complexities associated with building projects, huge complexities, building and designing, and then also operating at a physical level. So I'm starting with the revenue side. Let's call them imbalances that are created by fluctuations in both supply and demand in real time. And if you imagine the wind changes direction ever so slightly, the amount of power going onto the grid may rise or reduce very significantly when you've got approaching 30 gigawatts of installed wind power. That's our entire demand. Right now, when it's actually near 40 to 45 right now in these colder months. But the installed capacity of wind is very, very high, but operates typically at a capacity factor which is below 50%. So it's not often expected to generate all of it all the time. But we have a record export of over 20 gigawatts now on a live basis. But sometimes it can be very close to zero, and it's fluctuating all over the place. So the impact of that is that it causes imbalances in very short order, which are very difficult to trade away. And so, but do impact something called the frequency of the electricity. So the power is meant to be at 60 hertz in this country, 50 hertz. In the US at 60 hertz, if I've got that right. And National Grid themselves have to make sure, as the entity that's tasked with making sure that supply and demand balance, have to ensure that they have the technologies at their disposal to make sure the balance is so good that even the frequency doesn't move much. So we get contracted to provide those services without actually trading power. And we're actually paid a service fee or an availability fee, effectively, for delivering that service. And trading is a derivative of that that we have to factor in on our side. National Grid don't get involved in that. But at another level, we can also trade actively our battery to take advantage of power price fluctuations, which are a function of the supply-demand function, the larger supply-demand fluctuations. So there's two levels. There's real-time with frequency response, and there's larger blocks that are, not real-time, not second by second. It's more half-hourly by half-hour, which we take part in, and is very much a more commercially driven business. So those are some of the complexities around the revenue level. At a technical level, you've got a stack of different technologies from civil works to batteries, which then have to be wired up to each other because, I mentioned the cell is, south of the 500 grams, half a kilo. But we've got thousands of these spread across many, many different containers. And each of these cells has something called a battery management system on it, a very, very small chip monitoring its voltage, its temperature, and a couple of other things. And essentially, they have to be monitored, and then they have to be monitored as subsets together. And so you sort of cells are then combined into what we call modules, which are then combined into racks, and then combined into containers. And so there's a lot of granularity that builds up. And then, of course, you need IT networks or fiber optic networks around these sites to let that information flow so that they can be operated actively. So a lot of complexity.
So you have a huge operational aspect. This isn't investing and then it runs. So you have a couple different revenue streams.
Actually, three core revenue streams. I mentioned two of them: frequency response and essentially trading in different ways. And the third one is something called a capacity market contract, which only expects you to do anything very, very rarely when there's something called a stress event, which is essentially it's never happened since the beginning of capacity market contracts in 2015. And no assets ever being called under a capacity market contract that I know of. And essentially, it becomes a mechanism through which the powers that be, combination of Ofgem, our regulator, national grid, the government, and so on, ensure that there's an extra incentive for the installation of the necessary capacity that's anticipated to be needed to compensate for either growing demand or the retiring of old power, and therefore we need a replacement to show up. And in the case of batteries, which really to show up also to support renewable infrastructure.
So could you walk me through a good example of a project you feel that really demonstrates your strategy kind of from the beginning? Like, how do you select an investment? What do you have a pipeline, or how you're developing these and finding the land, the construction, to installing the batteries, switching it on, hooking it up? How does it go?
Okay, you're asking quite a complex question, but I'll simplify it. And essentially, there's a stage that was called development, and in traditional English, development can actually mean the build phase. I'm not talking about the build phase here. We're talking about very much the assembling of the necessary project rights. And project rights are essentially anything that allows you to then break ground and know that you can continue the construction all the way through to commissioning without hitting any buffers like, whoops, that piece of land we're not allowed to go over, how we're going to get the cable over to the substation. That's an example of land rights that you will need. So the rights that you need are the access to the land, the necessary planning permission, as we call it in this country, but zoning effectively, and then specific permission to build the specific thing that you're looking to put on the land. Because land might have, oftentimes, is the agricultural land sitting around a substation, whether it's heavily used or otherwise, and we have to ask for effectively a change of use and the installation of this infrastructure. And there are various national rules that guide both local planning authorities for smaller projects and the national government in terms of the national planning framework in terms of deciding whether something deserves to be put in such a location, even if there is an impact on all sorts of different things, visual impacts or mostly visual in the case of batteries, but potential other impacts such as traffic during the construction phase. So you need to apply for that permission. You have to submit designs and construction, sort of plans and traffic management plans and so on, very much to reassure and appease, local communities and the local councils. So during, that you will mitigate, and they insist that we should mitigate the impact on the community, especially during the construction phase. So you have to assemble the project rights. Those project rights are not assembled by the fund that I run. They're acquired by the fund that I'm responsible for. They are created elsewhere by what are typically called developers. And developers are from individuals to smaller companies that literally, do the different things. Contact landlords, acquire land, secure leases, and so on. And so the other key item is obviously applying and securing a grid connection offer. So this is actually one of the big topics of discussion is if you want to build projects, if you get a grid connection offer these days, what are they going to say it's going to cost you to connect? And when will you connect? And one of the big topics of discussion, both here and in many other countries, is blimey, one of the forgotten realities or not much mentioned realities is the number of projects that will be connected to existing network infrastructure is so significant. The grid companies are, wouldn't want to say that they're overwhelmed, but they're very, very stretched. And therefore, the only way they can deal with that is by saying, we're going to connect you in 2034. Here's in terms of incremental connections at a particular node. And so debottlenecking that is a major imperative for policymakers at the moment and for national governments.
So you're not putting these projects together, you're evaluating a pipeline of these projects and then investing in those and funding those.
Correct. If we, in the many fund managers behave this way and do this, and it's very much within their mandate to do that. And one of the ways that we like to differentiate ourselves is to actually carry out a degree of development activity within Gresham House. And the reason and rationale for that is, number one, you've got to control an oversight of a project from virtually the greenfield status, and therefore can determine whether you like it or not at an early stage and discard it, or if you don't like it. You can influence the design and therefore what gets submitted for planning, so that you don't then have to resubmit, because so often you have to resubmit to planning. So even though a site has permission to build a battery project, what actually you end up building, usually it ends up being a bit different, especially as the technology is evolving and also the requirements are evolving, such as fire requirements and so on, for fire safety. And so you want to mitigate that as much as possible, because each planning cycle is quite laborious, time-consuming, and a little bit costly. So that's another thing we want to make. And of course, the main advantage is visibility of your pipeline and a cost saving for the fund. So the fund has acquired projects far more cheaply they would be acquired than they would cost if they were just bought fully finished by another developer, selling it at the highest possible price to the market.
So you end up funding a project that you're investing in the project. This operator developer builds it, hooks it up and turns it on. And then who actually operates it?
So the construction process is very much overseen by ourselves. We select the construction company to build it. And increasingly, we are breaking up the different parcels of work and managing those ourselves, again, to save money. And because the margins charged by turnkey contractors are very high. So again, another way of mitigating the cost of construction is by getting involved in it. And I've been doing that for a very long time. And we have a dedicated team actually managing the construction program and running procurement and all things as well. So we're very involved even at that stage. And then once you reach what's called COD, the commercial operations date, it becomes taken over by our operations team, who basically monitor the site and monitor the operations and maintenance contractor, which is a different entity. And usually the entity that built it, but not necessarily if we built it, the coordination of the construction ourselves. So the operations then is the operational team then manages the site from all sorts of perspectives. So maintaining the different contracts that you need to maintain, such as leases, grid connection contracts, and so on. The payments, the renewals of contracts, such as operations and maintenance contracts themselves. And then, of course, the appointing of the relevant trading entities that will then dispatch the batteries. And they're actually called optimizers, to optimize the revenues possible from the marketplace. So there are companies in the market today, all over the world. So it's very much the same model everywhere. Very, very few battery operators today do their trading in-house. That's likely to be a trend that shifts as we gain scale. But right now, we are outsourcing the actual day-to-day trading of these batteries to optimizers that we monitor and work with through our commercial asset managers, as we call them internally, which make up a subset of our operations team.
So you're not doing the trading in-house?
We know what we want to see.
Right. Okay. So then how do you evaluate your investments? You've found this project, you've invested it, you funded it, or you actually get quite involved in the construction. You turn it on, and then you're storing and somebody's doing the buying and selling of the energy stored there. Do you evaluate each one of these independently? How do you do that?
So a lot of the infrastructure investments see their economics locked in on day one. And by day one, I really mean the final investment decision point or financial close, rather than the day in which you turn it on. You've made decisions to pay for batteries, build out a certain design, accept a certain grid connection cost, accept various ongoing charges, accept lease costs, and so on, and accept a particular location for a battery. And all these different things, you have to live, most of these different things, you have to live with thereafter. You have very little potential to change a lot of those things. One thing that you can change is the duration of the battery. So if you've got a 1 hour battery, it takes an hour to charge or discharge from full to empty or empty to full. You could add more batteries to change the duration. That's something we're actually looking at because there's enough trading opportunities to run them in one direction for long enough to justify that incremental capacity. That's something we can do. But really what we're trying to optimize here is the sort of limiting the upfront cost of a project so that you've got the greatest margin of safety to hit your returns over the longer term. That's why we're so focused on development and so focused on construction, because it is the entirety of the cost of the project. And then once you're operational, the real focus of our operations team is to focus on maximizing revenues by getting the best optimizers working for us and also managing uptime. So making sure that the batteries don't go offline for any reason. And our uptime is extremely good. We're up in the very high 90s in terms of percentage terms. And the majority of the downtime is actually driven by the need for outages and for the grid companies to upgrade something or to deal with storm damage or whatever else it might be.
Do you ever sell a project or not once it's constructed and after you operate it, you determine it's not giving you the return you wanted? Do you sell them?
Projects are tradable. It's quite rare for projects, whether it's in the renewable space or in the battery space, to sell projects unless their fund reaches an end of life. But this is a closed-end fund, so it doesn't reach end of life. But being an investment trust, one of the features is that there is a continuation vote every 5 years. And should the shareholder decide not to continue, the board has to look to either restructure the company or wind it up. So that happens in REITs, for example, sometimes and so on. So unless that happens, the motivation to sell, and it just so happens that we do have a sale process in train right now, is driven by any number of things. To raise capital when you can't raise any, that's one. To demonstrate that the valuation ascribed by the market relative to the NAV is too low, and therefore you try and sell your project at NAV, at NAV. And therefore show that the market's undervaluing your projects. That's also topical right now. And then from a mixed perspective, some of our earlier projects are smaller, and there are some players out there who are happy to buy smaller projects where actually, our smallest project, for example, is 5 megawatts. We've got a handful of projects below 20 megawatts, a small handful. But we're incrementally building projects of 50 to 100 megawatts. So there's a motivation to, I wouldn't call it, you could call it tidy up, but essentially to rationalize and
You've only got so much mind share and you're trying to leverage that. Yeah.
where you
Yeah.
absolutely.
You announced last year a battery storage project in California alongside NextGen, which was your first project that you've launched outside the UK and Ireland. How transferable is the system that you've developed in the UK or GB when you're looking to expand into new market? Why aren't you going everywhere?
There's a huge degree of transferability. First of all, if you know how to analyze a market, and bear in mind my background going back to the beginning of the conversation, if you know how to analyze a market, which we did initially for Great Britain and helped develop it as well, you can then know where to look and how to look at a new market. And the US is a very interesting market. In particular, California is a very interesting market. It's benefiting from the Inflation Reduction Act, sort of introduction of the investment tax credit for batteries or battery projects, and especially standalone battery projects, but also co-located battery projects with solar. And the meaning that you get a significant rebate. There's also a much more contractual structure in the US, where I mentioned capacity market contracts. There's as a layer of our revenues. There are higher levels of they're more generous payments in the US than in the UK. And I think the UK should revisit the way it subsidizes or supports batteries, because I don't think it's doing the best job. So there's much more support for batteries from a fully contracted basis over there. But otherwise, batteries, and bear in mind that the electricity industry evolves around the world at the same time. And so different governments and or national grid companies shared their experiences and developed networks in very similar ways. And of course, their regulatory structures are slightly different and sometimes very different, but essentially they all rhyme with each other. They all look at frequency as the goal to maintain. They all appreciate that electricity needs to be balanced in real time. They all deal with what we call ancillary services or frequency response services to address those short-term real-time imbalances that can't be traded. They all have wholesale markets. And so there are a lot of similarities. It's just that the way they're implemented can vary. And then it's just a case of learning what that is. And so that's one category from the operational project perspective and the modeling of a project before you build it. But then the development of project rights also chimes. You need to sort of, but the rules vary. Sometimes you need a construction license. Sometimes you need a planning permission. Sometimes you need something else. So it just varies. But you always need a grid connection offer. You need a permission to connect to the network. But again, that can be broken down in different ways. And the timings of payments can vary. But essentially, it's highly transferable because you're just rerunning the analysis with the rules that apply to the locality. The tech is the same. You install the same stuff.
Are there other competitors like you out there doing this?
We have had a competitive advantage in Great Britain. We were the first to launch. We're still the biggest in the country, with approaching 25% market share. So we're still very significant in this country. Internationally, though, the markets are developed in a lagged fashion to the UK, or GB, which was the first major market, although Korea actually sort of built more earlier because it's got a large battery market, and so have the Chinese. But the US has grown very, very rapidly, and other European markets are catching up fast, like Spain, Italy, Germany, and others. So the whole world market is evolving. Its battery energy storage market.
So ostensibly, you could scale abroad.
Well, absolutely aim to scale internationally. Absolutely. I mean, the UK is that to share is just 1.5% of the global electricity market. I don't want to miss out on all of the rest of it.
Are there any specific risks with your strategy? Is there anything specifically with you, for example, battery technology?
There's always a disruptive technology risk, but I think it's very, very low. There's always a risk that we have issues and there's changes. I think the biggest risk here right now is policy, government policy, and regulation. And I never expected to say that, actually. We sort of moved on from where our share price was to the now. But the simple reality is that at the moment, and I say at the moment because we are trying to change this, at the moment, our major counterparty in this country, and the major counterpart we will have in other countries, is a combination of the government and National Grid. National Grid has to balance the market and therefore influences how the market behaves. They are our counterparty when bidding for frequency and then when running frequency response contracts. They are our counterparty. National Grid runs the auction regime for the capacity market auctions, even though they're funded by the government. National Grid operates the traded market. And essentially, you've got a commercial market which has buyers and sellers of power, but they're not obliged to buy and sell exactly what they promised in the contract. There's allowances for variability. Otherwise, you'll be forced to turn your switches on exactly when you want to. And every wind turbine will have to generate exactly the amount it should. So batteries come in and dip into that, but there's still a residual imbalance. National Grid trades that balance away. One of the realities that we've become unfortunately aware of over the last year is that National Grid's ability to trade batteries has not been there. They haven't had the systems in place to turn on or turn off or sort of export or import power from the battery fleet, simply because they didn't have the systems in place, because they were used to trading very large assets, which could be instructed manually. But when you've got hundreds of batteries, which are much smaller than large gas-fired stations, you have to automate this. And that automation had not happened. So there's a counterparty risk, a policy risk, a regulatory risk that National Grid, for example, needs to action its upgrade. And there are policies in place to encourage that. But if it doesn't happen, we still got to live with that reality. The good news is that we have good relationships with National Grid. We understand their rates of innovation, that these new systems are coming along and so on. But the reality is that has thrown us a curveball over the last year and has impacted our ability to generate revenues, as an example, as a major example right now.
You said, I think renewable energy only represents around 40 or 45% total in Great Britain. How do you view the path to 100% renewable energy in the UK, and what will be the accompanying trends in the marketplace as we go down that path?
So I mentioned, I think earlier on, that in 2011, we were about 11% renewables. Most of that was wind. When we launched the fund, we were in 20 to 25% renewable in the UK. And in the last 5 years, we've been operating for about 5 years, just over. We've gone to double that. So it's doubled. The good news is that there's a subsidy regime called the Contract for Difference regime, which subsidizes primarily offshore wind projects. And contracts are awarded on what's called the T-4 basis. So you've got basically 4 years to build out your project. So we know what projects have T-4 contracts right now, and what is likely to therefore show up over the next 3-4 years. When you look at that, I'm very confident that within 5 years, we're going to be at about 70% renewables in this country. In about 5 years. I mean, it depends on where demand goes. It depends whether everyone builds their projects or not. But yeah, absolutely. So that intermittency will only grow. And one thing I haven't said the whole time, despite the amount of time we've spoken, is that renewables, as a rule of thumb, in this country, and it will vary by country, and that's one of the other big differences by country, is that weather is very different. And all these renewables are driven by the weather. So in this country, which is quite windy, and we've got a preponderance of wind generation, is that they can generate anywhere between very close to 0 to 200% of their expected average over a quarter or 1 year period. So that gives you an idea of just the extent of the intermittency. You can be at twice what you need or very close to 0 for an amount of time. And that amount of time might be a few minutes, or it could be a few days.
Are you taking any steps to ensure a responsible supply chain in battery production? And on the environmental side, are you doing anything to mitigate detrimental environmental impact generated during production? And of course, there's this whole question about disposal on the other end of the thing.
Yeah, recycling, yeah. So the simple, unfortunate reality, and I made it very clear, we're an Article 8 fund, not an Article 9 fund under SFDR. There is an impact, a negative impact of the creation of these sites. The silver lining is that they're dramatically less impactful than what we're doing right now. The beauty of renewable power is that you install something, and of course you have to maintain it. There are bits and bobs you have to do around the edges, but basically it's installed in place for decades, not requiring a truck, a ship, a drill to go, and every time you burnt it, you got to go and replace it every time, right? So just think of, there's some good graphics out there you could Google or find on LinkedIn or whatever that show. So what you're really addressing is the embedded carbon and embedded environmental impact of a site, batteries included, because they're not using a fuel. Okay, they'll have backup generators for all situations, but they're not going to be used very often, very, very rarely, in fact. So you're really talking about a solar farm or a wind farm or a battery being installed for decades. You have to go to a hillside or combination of hillsides around the world and source those materials. Unfortunately, that's the reality. There's an environmental impact. I'll come back to the labor aspect in a second. There's an environmental impact of that. But the good news is that it has a really long shelf life. And so the longer you can make that infrastructure work with no fuel use, because and to generate the renewable energy thereafter, the lower the impact, the greater the payback you get on that damage that you've caused, whether it's environmental in terms of habitat impact, or whether it's embedded carbon from the creation of the steel and concrete that you've created, which increasingly will be decarbonized, because even that's being electrified. If someone who doesn't put their hand up and say the reality is that there is an impact, that it is wrong. There is an impact. It's just much, much smaller than forever digging coal out of a hillside, extracting methane, losing some of it, which has a horrible marginal impact on CO2, on CO2 equivalent emissions, because methane is way more greenhouse gas-like than CO2. And again, you don't have other emissions like soot and other sort of noxious fumes. So the reality is that there is an impact. It's a heck of a lot smaller than the status quo, than the fossil fuel world. And again, we have to work to try and improve on where we are now. Speaking to supply chains and labor practices, there's something called the Anti-Slavery Act in the UK, and actually is a European level legislation as well. And companies have to declare that they are not allowing labor laws in other countries that result in the exploitation of people. It's a thorny issue because it's very hard to track, and even major companies are being caught out all the time. But there's a very, very significant focus on this, and we care about this a lot. And we've done some bespoke reports on the battery supply chain itself as the majority of the bulk of what we source. And also we're using what we call LFP batteries, lithium iron phosphate batteries today, because of the serious concerns around the cobalt in mining industry, where artisanal mining and labor is frankly rife, apparently. So we're very aware of these different topics.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.